Let's talk about apartment investing strategies. So there's several different strategies just with the buy and hold strategy. Let's start with that one. The first one is buy and hold short term. So this is someone that's going to buy a property for 5 years or less, and they're most likely going to try to swoop in and buy that property where it's distressed, or they want to buy it quick on the market, and then they're going to turn around and flip that property. And we're going to talk about buy and flips later, but with a buy and hold short-term strategy, the goal for that investor is they want to own that for 5 years or less. So one thing that they're going to be looking at is, can I go in and make improvements to that property and do a value add opportunity, like go in and change the appliances, change the flooring? What can I do that's quick and easy and not break the bank to do it, and yet I'll see the dollar for dollar return when I go to sell that property? So investors that are looking for that 5 year or less hold strategy, that short-term hold, they may want to look at taking a 5 year fixed interest rate if they need financing versus paying cash for the property. I see a lot of investors that are on that short-term strategy that will use financing. Now, if you want to win the property when you go to make an offer for it, your best strategy is to pay all cash, because I can tell you, I just recently had a property where I brought it to the market, and within 24 hours, we had 32 brokers tell me that they were interested and had a buyer that was interested. We received 9 written offers, and 4 of them were all cash above the asking price. So if you want to win a property, especially if you see the value add opportunity, or you know that you could go in and make improvements to it, try to pay cash, close on the transaction, and then you can go do a cash out refinance with your bank or your favorite lending institution and replenish your cash flow. And again, if the short-term hold is your strategy, look at doing a 5 year fixed interest rate, because that's going to get you a lower interest rate than a 10 or a 20 year fixed interest rate. Which leads us into the buy and hold strategy for the long-term investor. The long-term investor is typically buying for 10 to 20 years. And in that situation, I recommend that you look at least a 10 year fixed rate, if not trying to go for a 20 year fixed rate. 10 years is typically the longest that most lenders will want to offer to you, unless you go to like Fannie Mae or Freddie Mac on the larger properties. Now, Fannie Mae and Freddie Mac really don't want to get their hands dirty for like $1 million loan. They're looking for the bigger stuff that starts in the $3 to $5 million range. They definitely get excited in the $10 to $15 million range. That's where Fannie Mae and Freddie Mac says, here's the most aggressive interest rates, here's the most competitive loan programs that we can offer. So if you're looking to buy and hold long-term in your portfolio, maybe it's a Class A or a Class B property, and you just want to hold this and pass this on to your children or your heirs down the road, look for long-term fixed interest rates. And the reason I recommend that is you never know what the market will hold. Interest rates could go up pretty quick, and if you're on a 3 year or a 5 year fixed interest rate, you may have a couple of more years before you could go to a better interest rate. So just get the best financing that you can up front if you're buying a property for a long-term hold play. The next strategy would be that value add or the rehab value add opportunity that I mentioned briefly. That's where you're going to upgrade properties to increase the rent, which basically increases the total revenue. That value add opportunity is also where you're going to look at ways that you could reduce the operating expenses or drive the operating expenses lower. Or you look at repurposing a building. I've seen situations where multifamily owners have bought property that's right on the fringe of a neighborhood that's transitioning from maybe industrial or primarily office, and now the zoning will allow multifamily in there. They'll go in and they'll buy a building and they'll put in units, and while it may not be Class A, the tenants love living there because it's affordable housing. We call that workforce housing, where tenants can afford a modest rent and they'll live there long term. So look potentially at repurposing a building. And again, you're gonna typically see those on a fringe market where it used to be office or industrial, and now you would qualify for multifamily. The fix and flip situation is typically for distressed properties, and that's where you're gonna fix up the property and resell it at a higher price. Fix and flip can be interesting. Lenders don't typically like to get involved with fix and flip because you're looking at a distressed property and you know that you're gonna fix it up and add value to it, but the lender doesn't know that. And the lender doesn't have any guarantee that you're gonna do that and follow through. So you're most likely gonna need to either get a construction loan, which can be really laborsome and difficult to qualify and expensive, or you go to a private money lender where they're gonna charge you a higher interest rate and give you a short-term loan. Typically for a private money lender, they're gonna loan you that money for 6 to 12 months and expect that you're gonna pay that loan back after you finish rehabbing or fixing up that property and you resell it. I have some friends that are real estate brokers that have made a lot of money doing fix and flips. It's not my preferred way to make money because I'm not really handy. Both my husband and I, we don't know which end of a screwdriver to pick up. So fix and flip is not something we enjoy. We have done one of them. We about killed each other and swore that we would never do it again. But again, I've got a lot of friends in the real estate business that fix and flip has been very, very profitable for them. And I also know that across the country, especially in Nashville, Tennessee, as an example, you can find some pretty profitable opportunities right now where you can buy single family properties at a low price, go in and rehab them, fix them up, and then turn around and sell them. Check with your CPA or tax strategist on the fix and flip strategy, because if you're a real estate investor, you may not necessarily be able to do a 1031 exchange out of that property. You may have to pay tax on the profit that you receive from that property from that fix and flip profit. So ask your tax consultant or your CPA on their thoughts on that before you just jump in and buy a property. But there are some great opportunities for fix and flip. Then let's talk about new construction or development. It's high risk, but it has great rewards. The risk is securing financing, finding the right contractor and the laborers, and also dealing right now with the cost of construction materials. They doubled and they tripled overnight for lumber and the different things, framing, the different things that go into building a multifamily property. So a lot of people who are in the middle of building multifamily properties right now, those developers are experiencing that their profit margin is shrinking substantially because of how the cost of the construction materials have doubled and tripled faster than they can get the project completed. I've actually heard of situations where the occupancy permit is basically ready to be issued for the property to be complete, but the doors are not in yet because they're waiting for the materials to arrive. During COVID, a lot of the lumber mills and the different manufacturers shut down because they thought we were going into a recession, but the builders were only off work for a very short window, and then they were deemed that they could go back to work because they were a needs necessity business. Well, everybody was home with COVID and realized, hey, I don't like my family room. I don't like my master bedroom. I'm gonna have that replaced. So they started hiring these general contractors. And then all of a sudden, all the doors got taken up, the lumber, the sheetrock, the framing materials, all those materials just evaporated. And so the new materials coming on the market is doubling and tripling in cost. And so it's really tough right now to build new units. Not a lot of people have the stomach to ride that roller coaster right now of the risk versus the reward. So I talked about the risk. The risk is, can you stomach hiring a contractor? Do you want to maintain the laborers? There's risk of your expenses going up. But the reward is now you have a brand new Class A property and you're able to increase your rents. You're able to get top dollar for rent because you have a brand new property. So for some people, the new construction is a great opportunity and they are willing to weather the storm because the reward and the benefit is greater and they're willing to take that risk. I talked about distressed properties. We typically see those in less than desirable neighborhoods. So if you're willing to take that risk and buy a property in a distressed neighborhood, just make sure that you talk to a local market expert to make sure that you can get your money back out of that once you buy that property, because that could be a rookie mistake that you could make that could cost you a lot of money. And then let's talk briefly about mixed use. So a mixed use property is where there's retail or storefronts on the ground floor, and then there's units, multifamily units above that. Now you typically see that in urban areas or cities, and the reason that you see that is because that's what the city zoning requires. They're going for maximum density. So they want those high-rise apartments with the units above the ground floor retail because they know that tenants are gonna love to live in that area because you can walk right downstairs and there's gonna be a convenience store, a restaurant, a dog grooming facility, different things that the tenants and the surrounding tenants in the neighborhood can use. So it's very appealing, and the mixed use is really interesting for a lot of tenants. Now, most banks want to make sure that if you are buying a mixed-use property that you have experience, because not all people, not all investors have experience in dealing with retail tenants. So if you've never bought a property like that, make sure and talk to your lender first. You're also going to need to hire a professional property manager because the bank will require that. And the benefits, again, of that is that you've got businesses in the ground floor that will support your tenants upstairs that live there, and that's going to help your tenants stay longer. Click on the link down below to sign up for my newsletter for free tips and information for apartment owners. I'm Rene Nelson with Pacwest Commercial Real Estate. Have a fantastic day.